So in this past month, we've seen tech stocks sell off fairly aggressively. Here we have the QQQ, which essentially tracks the NASDAQ 100 index. And it's a good reflection of current sentiment on tech stocks. And you can see in the past month, it's down around 6.5% to 7%. It's had a little bounce back today, as you can see, but sentiment around tech stocks is fairly negative. Now, you might think 6.5% isn't a big drop, but for a diversified index, it is quite a substantial drop, especially just in a month's period of time. Now, if we dig deeper into specific tech stocks, we can see some more very large drops from where these companies were trading a month or so ago, or even a few months ago. So there definitely is some opportunity out there for people looking to pick up good stocks or good businesses trading at fairly depressed prices. And so there are two stocks that I want to talk about in this video that I'm keeping a close eye on and will be adding to my portfolio if and when they reach my intended buy price. One of the stocks I've spoke about on the channel already, and that is Farfetch. And then the other company is Wix, which we haven't spoken about. So I'll spend a bit more time on Wix today than Farfetch. But essentially, what I want to look at here in this analysis is how far these stocks have dropped and what the sentiment is, what the current valuation now looks like off the back of that drop, as well as look at the potential long thesis for these companies, and then lastly, what my intended buy price is for both of these stocks in the coming weeks. And this video is going to be a little bit longer than usual just because we're covering two potential buying opportunities, but also because we're going deeper into why I feel they're a good opportunity after the recent sell-off, and talking about how I'm getting to a fair price to buy both of these stocks based off of my estimation. So stick around for the entire video if you can. Hopefully, even if you're not looking at Wix or Farfetch, you can take something from it to go into other investments. And so if we start with Farfetch, you can see Farfetch stock has had a real torrid time the past 6 months, even year to date as well. The stock's down from around $62 at the start of this year to around $36. So a 40% drop year to date. Ouch if you are a Farfetch investor or were a Farfetch investor near those highs that they reached. We did see this stock actually have a huge run up, just after its low in the coronavirus pandemic. Everyone sort of realized the value of this company in a market where they needed e-commerce solutions. If you don't know already, Farfetch is a luxury goods marketplace. So it done very well, and then now it's got a little bit of a hangover from those highs, and we've seen a fairly significant drop, almost half from its high back in February. So there's a possibility that Farfetch has oversold because there has been a big drop, but we'll look at that in a bit more detail later. Wix, another one that year to date has really struggled. This time last year, it was selling at around $265 per share. It's now down at $179. So you're looking at down 33% in a 12-month period. Not what you would want to see, as an investor in Wix if you invested back in October last year. On a 5-year basis, this is a stock that has done very well. Since October 2016, it's up 315%. So it's tripled in price in just 5 years. So investors in Wix, if you're in it for the long term, have done very well regardless of this recent drop. But to dig deeper into what that drop means for both of these companies, we'll just look at the current valuation and try and compare that to previous year's valuation as well. We'll start with Wix because it's here. We're down at around 7 times or 6.5 times, next 12 months expected revenue. 6.5 times in the past year, that is the cheapest that it's been. That multiple is nearly halved since this time last year, and albeit 13 times next year's revenues may have been pretty punchy, but the business has been growing at around 30%. So you can't blame investors for getting quite excited about the prospects of this company. If we zoom out a little bit more on a 3-year basis, we can see that it's not an all-time low or anything like that, but you can see the best time to pick up this stock was around the 5 to 7 times revenue mark if we look at the previous years. So if you would have bought the company back in December 2019 or even December 2018, you would have had something like a 20 to 30% annualized return. So versus a mean or average multiple of 9 times revenues, it's now at around 6.5 times. It looks like it's a depressed valuation relative to where it's traded before. Now, Farfetch, the next one that we're going to look at, we see a similar story with Farfetch, although we can't go back as far. There was a period during the coronavirus where this stock was selling really cheap. So for a company that was growing its revenues at around 60%, at one point it reached 1.5 times next trailing 12 months revenue, which I can't quite fathom how I didn't spot that at the time, maybe because I didn't have exposure to the company or to the stock. But that would have been a brilliant time to pick up the company, even with the 50% drop we've seen from its high. I think that still would have been a 4x or 5x from that price. I think it's pretty safe to say it won't reach $7 again, and if it does, you should definitely buy up the stock in bulk. So yeah, 5.5 times or 5 times next trailing 12 months revenue. For a company, if we just look at its financials, that's growing its revenue 50 to 60%, it's probably going to be 40 to 45% going forward, but 40 to 50% even for a company selling at 5 times next year's revenues, that looks very cheap on the face of it. And so all in all, we've got 2 fast-growing businesses selling at reasonable prices, and they're out of favor with investors. So we need to know if these businesses are high quality and what the likelihood is that their success is going to continue. Because it's all well and good looking at the past growth rates and things like that, but if there's a valid reason for this stock sell-off, i.e. growth is going to stop and they're going to stay flat for the next couple of years, then maybe it is warranted. And so we'll jump into the long thesis or potential long thesis for both of these companies to try and answer that question. We'll start with Farfetch. Again, I have made a video on Farfetch, so if you want to dig deeper into what I'm talking about, go ahead and watch that video because I'm not going to spend as much time on it here. I just want to recap. So Farfetch predominantly is a third-party marketplace for luxury goods, serving consumers worldwide through their thousands or hundreds of brands and boutiques who sell on the platform. They also own various luxury brands directly, which they'll sell on a first-party basis on their digital platform and in store. And then they operate a technology platform that provides luxury brands and partners with sophisticated e-commerce solutions, which is something I'm very excited about for this company. I have to say, I think the tech platform play is definitely something that makes them stand out. Now, they currently have around 3 million active customers on an annual basis, probably grown from that now since they reported that number, and they produce around 2 billion in annual revenue, just shy of that as of the current quarterly results that they put out. But like I've said, the company does seem to be losing money hand over fist if you look at face value, but if you dig deeper within the cost, it can quite easily make money on a steady state basis, even with the current revenue numbers and with lack of true marketplace scale. And what do I mean by steady state basis? Essentially what I mean by that is if you strip out all of the non-essential costs, so everything that's just used for growing the business, it's not required to maintain where the business is at currently. So to maintain the business, you're looking at obviously cost of goods, you're looking at a lot of the general and administrative staff salaries, things like that. You're not necessarily looking at demand generation, although some of that would be required. Technology expense, you're looking at a portion of that being maintenance, and then a lot of the technology expense is going to be growth spend, like product development. There's a lot of money spent on that with Farfetch. So there's definitely a sense of the market maybe missing out on the fact that Farfetch can be a profitable platform in the future, coupled with its explosive sales growth. And against this 2 billion of revenue, they're fishing in a pool of 350 billion of TAM, and that being the luxury goods market or personal luxury goods market. And the online or digital penetration of this market is lower than most other industries for personal goods or fashion items. So there's definitely a longer runway for growth. To put a number on that TAM expansion opportunity, the TAM is expected to grow. The online penetration portion of the TAM is expected to grow around 20 to 25% for the next 4 to 5 years up until 2025. So like I said, please watch my full video on Farfetch for more information on why I'm excited about this company, but hopefully that gives you a brief summary on the thesis and why I expect growth to continue. So the long thesis for Wix, let's just switch over to that now. And as a bit of background on the company, it's a cloud-based web design and hosting platform that lets individuals create quite expansive websites or even run their business online without any coding or web development skills. They offer sophisticated DIY websites for various verticals such as e-commerce, restaurants, and fitness for bookings and things like that, plus many more verticals as well. In terms of their revenue model, they offer a freemium model which allows users to actually create their site for free and try out the product. Once users want to take the next step and make their website a fully fledged domain for operating their business, they pay a monthly or annual subscription fee, which is relatively small in the grand scheme of things, and they can pick and choose various add-ons and subscription packages which expand the capabilities of their website. They've currently got around 200 million registered users and estimated to have over 5.5 million, close to 6 million paying users as of today. The total amount of non-paying users just shows you how huge the opportunity is for Wix to acquire more customers, as the freemium model acts as a cost-effective funnel for new customer acquisition. Now, if we're to be long on Wix, we need to know that it is here to stay and has some sustainable competitive advantages that it can leverage over time to build a moat. And I think they have a few, one being their stickiness. Customer revenue retention is a prime example of this. It's sitting at around 110%. That means users tend to increase their spend with Wix over time, and users tend not to switch their website, once they've built it, unless there is severe issues with price and functionality, which there isn't any with Wix. All of the reviews are very good, and the pricing is relatively small to the value that it actually gives to the customer. So on average, with that customer retention, 110%, it tells us that customers spend $1 more each year for every $10 they spent last year. So the stickiness of the platform is one of their main advantages. Now, they do have competition in various forms, one being WordPress, another one being Squarespace, and they do have obviously competition in the e-commerce realm with things like Shopify and some other vertical specific site building companies. But if we look at the competitive landscape, I think WordPress is probably at risk from both Wix and Squarespace, and I think if there's going to be one business that's going to start losing a portion of their market share, then it's probably going to be WordPress, just because of its size. But measuring Wix against Squarespace, measuring it off against that, I feel their size gives them a clear advantage due to them being double the size of Squarespace currently in terms of the revenues that they produce and the customers that they have. This allows them to spend around double the amount on marketing, so bringing new customers onto the platform, and more importantly, product development, which sets them apart to become, in most people's eyes, the best website builder available today. All in all, though, I think there is more than enough room for both of these companies to prosper in this growing market. And speaking of the growing market, Wix see their current TAM around 185 billion US dollars, and versus just 1.6 billion in revenue, they only power around 1.5% of the websites worldwide, and their market share is just less than 1% as well. And you measure that against the CEO, who's also the founder of the business, and just to mention, all of the management team that founded the business are all still there. So it's definitely a company or management team that has a lot of skin in the game. And they've gone so far to say that they aim to be 50% of all new websites created in the near future, which is very ambitious, but that's the sort of ambition that you want to see in a CEO. Now, touching on the financials, there's a similar story with Wix to Farfetch in that they don't show an accounting profit, but they could quite easily be profitable. They are free cash flow positive and have been for a very long time. So remember, obviously, accounting profit is more theoretical. Free cash flow profit is more or less what is sitting in the bank account. And if we follow the same method of steady state earnings as a measure of current economics, and we take out some of the growth spending, such as the vast amount of money they spend on marketing to get new customers to the platform and put the brand out there, that's around 30 to 35% of revenue, so a very high amount of marketing spend, and the new product R&D spend, which again is close to around 30% of revenues. Then we get a steady state margin for Wix that is anywhere between 25 to 30% on a cash flow basis, just depending on how much of those two growth spends you think are either maintenance or used to maintain the business versus what's just in there as incremental growth. So it is based on opinions, but I do think that they could be a 25 to 30% free cash flow margin business in the future. And the gross margins, they have been declining year over year, and that's definitely something that people will probably pull me up on, but that's less to do with pricing power and the amount of competition coming in. It's more to do with the introduction of the business services revenue. And business services revenue is basically everything outside of the website builder, the core subscription business. Business services facilitates the e-commerce solutions like payments, eSuite, Ascend, and all of the additional services. So it's essentially a lot of the add-ons. Traditionally, it's lower margin than the pure SaaS product, but it's likely to start leveling out with scale. And also, it's part of what is making Wix the go-to platform. So we don't want it going away anytime soon. We want to keep investing into that business services revenue. And the CFO did actually say in a recent investor call that they predict gross margins will stabilize going forward from the core product margins increasing to around 80%. So gross profit should be around 80% on the software business, and then the business services leveling out somewhat with scale. So in a positive case, we should see gross margin stabilize from now on. And obviously we have a very high gross margin percentage anyway for the business. Now, looking at the intended buy price for both companies, I'm going to keep this relatively simple. And even though I have done models on both of the companies, I'm thinking pretty straightforward with my target buy price. And what it is I want to be buying these companies at a fair multiple. And by fair, I mean matching or below the expected growth rate. So if the expected growth rate is 25% for the next couple of years, ideally I want to be buying at around 25 times or 20 times those earnings to have a bit of a margin of safety. And then that multiple needs to be on my estimation of their steady state or owner earnings, because these businesses obviously aren't putting out an accounting profit at the moment. So most people will be looking at it from an EV to sales or price to sales multiple. But I think if you do the work to strip out what the steady state earnings are and we can match a multiple of that, then that's probably the best way to go. And that's something that a lot of the market aren't going to do. So if you do things like that, that's going to give you an investing advantage, give you a slight informational edge. So the price target for Wix is $170 per share. And that's really based off of 25 times steady state earnings and off an estimated 30% steady state free cash flow margin. And that 25 times multiple on the steady state earnings is coming off the back of 25 to 30%, or I'd say probably 20 to 25% growth into the near future. But because of the predictability of Wix's revenues, because it's a subscription model, the revenue retention is above 110%. I'm willing to pay up a little bit more, so I'm willing to sort of match the growth rate with the multiple that I'm paying of these steady state earnings. And then for Farfetch, the price target sits around $30 per share. So I haven't got to be under $30 per share, but it's close to $30 per share as we can get. And the basis behind that is 30 times the steady state earnings of the company. And like you saw earlier, I'm predicting that the steady state earnings are around a 16% to 17% margin currently. So it's 30 times that, and that's just off of 35 to 40% predicted growth into the future. So I want to be a little bit further down than the expected growth rate on my multiple for Farfetch, just because the revenues are less predictable. They don't have a recurring revenue model. It's a marketplace, obviously, so they have to keep bringing customers back to buy new products. So the revenue is a bit less predictable. So that's why I want the multiple to be lower than the expected growth rate to give me some margin of safety on that. But that's about it for this video, guys. Just wanted to touch on Wix and Farfetch. Spent a lot of time on it, and but hopefully it gives you an idea into how I'm analysing both companies, how I'm looking at the valuation from a non-DCF point of view, trying to keep it a bit more simple. As always, I'll leave a link to the Patreon down below where you can look at all the write-ups that I've done on these companies. So I've done written analysis on both of these companies and then various other companies as well. That's part of what I do on the Patreon each month. You'll also get access to my buys and sells, monthly Q&As, earnings updates on a lot of the companies that I own, as well as access to the Discord community. So go ahead and check that out if you're interested. Apart from that, leave a like on the video if you enjoyed it. Comment down below. Let me know what you think of Wix and Farfetch, and obviously if I've left anything out that you want to include. Subscribe to the channel if you haven't already. And I will see you all in the next video. Good luck with all of your investments.